Okay, well, good afternoon, everybody, and thanks so much for joining us today. I'm Lee Hodson, and today we're going to be looking at how finance and technology come together to reduce friction, improve control, and enable faster and more confident decision making. So, across the not-for-profit sector, we're hearing a lot that finance teams are under increasing pressure, whether it's rising costs, compliance, through to greater expectations from boards, funders, and executive teams. And often that can break down at that month end where we can see there's a lot of friction. So for many organizations, that close has become a very manual, reactive process with spreadsheets, workarounds, rather than a structured and efficient system-led approach where we have really good confidence in those numbers. So today is really about shifting that model. And to take us through this, I'm joined by two people who sit right on the intersection of finance and technology in the not-for-profit sector. So first, I've got Nunzio Giunta, who is managing partner. Sorry. Junta, who is managing partner of Junta Bell, and I think for over 25 years, Nunzio has been helping not-for-profit finance teams move away from that reactive month-end driven cycles towards a more system-led and operational that gives leadership really good visibility and control. So welcome and thanks for being here today, Nunzio.
Yeah, thanks, Lee. Pleasure to be here.
Excellent. And also joining us today is Brad. So Brad is Roden's Chief Information Officer. He brings a lot of experience as a senior executive, board member, and advisor across not-for-profit and education, with a really big focus on how technology can support governance, decision making, and organizational capability. So, welcome. Good to have you with us today, Brad.
Thanks. Great to be here.
So, look, in terms of what we'll cover today, Nunzio is going to take us through some of the core finance roadblocks and how we can start reducing reliance on some of those traditional month-end close with a more continuous approach. Then Brad's going to build on that a little bit more from the technology and governance perspective, focusing on how we can simplify environments and better align systems to support those outcomes. There'll be a bit of time at the end for questions. So please, if you have any questions, anything that comes to mind, feel free to pop them into the Q&A as we go. But with that, I'll hand over to Nunzio.
Yeah, thanks, Lee. Really appreciate the introduction. So I just want to say first and foremost, thank you for making the time to attend today's webinar. It's the 26th of the month, so that means most of you are preparing for that I call dreaded end of month close. And one of the things I'd probably like to share with you is one of my experiences with end of month close. It was approximately 10 years ago, and I was the CFO of a fairly large not-for-profit organization, and we had a brand new CEO start. And that CEO, basically the first board meeting coming up. And so the CEO wanted a really good impression in terms of the first board meeting. And so I had some really good conversations with the CEO. We had a timeline in terms of preparing the financial reports, and the finance team then worked towards achieving that outcome. So we worked really well. We got those reports out. We gave that to the CEO. CEO then distributed to the board, and so feeling really comfortable in terms of that process. I was then literally half an hour before the board meeting, reviewing my notes, getting all prepared, and I had that dreaded moment where I discovered a major error in our financial report, and it was in the balance sheet. And that horrible feeling of knowing that I now needed to call my brand new CEO to inform them that we had a major error in the financial report. And then the first 10 minutes of the board meeting explaining to the directors why we've had this major error. And at that point in time, I was really reflecting and thinking, well, how did this error happen? And really realized it was not about capability. It was not about the ability of the finance team to produce the information accurately. It actually was this process. We were locked into this process, end of month close, that was creating an environment of stress, an environment of rushing to be able to get this information out. And at that point in time, I made a decision. And I made a decision that I was going to dedicate the rest of my professional career to how do we eliminate the end of month close, and how do we get to a mode of being actually reduce that friction and move to a continuous close. And I suppose through that journey is where it's brought me today in terms of how do we use technology, but also how do we do change management in terms of the finance team to drive efficiencies. Now, on that journey, one of the things I realized is there's a fundamental problem. And the fundamental problem is that everyone has a different understanding of what actually end-of-month close means. So if you think about improving end-of-month close, in order to improve it, we actually need to understand what does end-of-month close mean. So I've been working on trying to actually get an understanding from different key stakeholders, what's their understanding of end-of-month close. So I first have spoken to boards and I've asked boards, well, what's an end-of-month close mean to you? And for boards, generally, it's, well, when do we have the certainty about the month? When do we have the information? Once you present that information for the board pack, that's our relevance to end-of-month close. So it's about having certainty on the month numbers. If you then ask a CEO, well, the CEO wants to understand their understanding of end-of-month close is I've got the information that tells me how we've performed, and I can send that report to the board. That's what the CEO's understanding is. If you then talk to the CFO is, well, when can I sign off on the numbers and have a good night's sleep? So that's their, the CFO wants to make sure the numbers are accurate, correct, and be able to report to the board and the CEO. The financial controller is, well, when is every account reconciled and every journal posted? That's financial controller's understanding of end-of-month close. Then the finance team is, well, when can we go home? That's their understanding of end-of-month close. And so you can see that there's 5 different key stakeholders that have a very different understanding. And I was actually at a conference recently, and I asked the financial controller and said, how long does it take you to close the end of month? And they said 5 days. And I said, oh, that's pretty impressive. That's great. And then I probed a bit and I said, well, when do you send the financials? No, we send that later on. And I said, why? And I said, oh, because we get feedback and then we need to make some changes. And so if you then think about it, that's the definition is the end of month close is actually when the financial report is. So fundamentally, what I've attempted to do is actually move to a model whereby we codify end of month close. And so the reason for that is this: everyone understands the concept of what we measure, we can improve. And therefore, what we want to do is actually codify that end of month close date. So therefore, we can measure it and then come up with ways to actually track it and improve it. So what I've come up with is a pretty straightforward formula. And so the formula is based on, if you think about when we're doing end of month close, and let's say the end of month close is May, and as we're moving towards a close, we're going to be doing transactions and journals in June for the previous month. So if you really codify what does end of month close look like from a finance system and a financial perspective is what is the last date that we actually made adjustments to May in the next month. So let's say the last day we did a journal entry, let's say it was revenue recognition, was on the 7th of June. The technical end of month close is therefore 7 days is our close cycle. Now, if we're able to then go back and track that month by month, that actually then clearly gives an indication and a measure on how do we get to a point where we then do improve on that close rate. So I suppose this is now the methodology I sort of lean into when talking about the end of month close for organisations we deal with. So just something to call out when we now talk about sort of end of month close. Now that we've sort of covered off on my inspiration to dedicate my professional career to improving end of month close, I now want to call out what are some of those key areas that I see, especially in the not-for-profit charity sector, that is disrupting the flow? What's actually causing extra days to close off the end of month? And one of the big areas I see is to do with revenue and revenue recognition. And most of you probably know that there were some fundamental changes to revenue recognition standards, AASB 15 and 1058, which was meant to improve revenue recognition, but in reality has made it more complex. And I suppose the way to identify and show how complex it can be. So let's take an example. We'll work through this together. So let's say on the 1st of July 2025, a new charity commences. And for that financial year, the 25-26 financial year, the new organisation had been awarded funding of $720,000. Now, let's say on 1 July, that organisation received $250,000 into the bank account as its first instalment. And during the month of July, $48,000 in expenses are incurred. Okay, assume these have been paid for by the end of July, and we're just going to ignore GST for this purpose. So the question is, how much revenue do we recognise in July? Now, most of you then, if you work through this example, and I'd love to get you to give you some time to work through it, but in the interest of time, I'll take you through potentially how we can recognise revenue. So if you look at one method is we refer to as being, I suppose, the received method. And this is the method. Remember, we received $250,000 in July. So one option is potentially we then recognise revenue $250,000 because we received that, we control that. And the expenses we incurred is $48,000. So therefore, the surplus for that month is $202,000. Cash at bank is $202,000, and therefore our then net asset position is $202,000. Okay? That typically follows AASB 1058, and it is really relevant when there's not really a contract or conditions in relation to that funding. So that's one possible way. The other one is compliant with the accounting standards is when you take up 1/12. So if you think about the grant over 12 months, we've now divided the 12, and for the month of July, we've now included $60,000 as revenue. We've then included $48,000 of expense. The surplus is $12,000. The prepaid income is $190,000, and therefore our equity position is $12,000. Okay, that's another way we potentially can do it. And a third is then, which I see very common, is what we call the expense method. And an expense method is whereby the expenditure drives the revenue. And the reason for that is that the only reliable way for us to acquit this grant is expenditure. And expenditure shows that we've demonstrated that we've actually performed our performance obligation around this contract or this funding agreement. And you'll see that now what happens is the revenue is $48,000, expense 48, and surplus is zero. And our equity is zero. Now, one scenario, three possible outcomes. And you can see if we're reporting to the board or management, very different consequences in relation to our balance sheet. And so therefore, what happens is that you may have multiple funding agreements that one of them you need to use option A, the other one, option B, makes sense, and option C makes sense for another. And so a finance team can really, if they don't have the right systems and processes in place, it can actually really put a big impost in terms of doing this calculation and managing each funding contract that then potentially drags out that end of month close. And so, what a finance team has to first do is really be clear on that funding contract, and does it fit AASB 15 and does it fit 1058? It needs to sort of work through a process. I won't go through that today, but this is just the steps that potentially you need to go through to determine which revenue recognition you need to use. What this is highlighting is you can't choose one and then just use that across all your funding. You actually need to be cognizant of each of your funding contracts and then calculate that and manage that accordingly for each one. The other thing is you then need to be cognizant of how does the different funding streams determine revenue recognition. For example, donations are very different to multi-year grants versus one-year grants. Now, membership and subscriptions typically are 1/12 if it's over a 12-month period. NDIS funding or disability employment services funding typically are fee for service and treated very differently. And as you know, from NFP organisation could have all these funding streams. And therefore, this creates a major impost of end of month close because you need to track this. And a lot of organisations and finance teams are doing this in Excel and not automating the process, and therefore drags out that end of month close process. As I said, the implication is that doing in Excel, lack of substantiation, and one of the key frustrations for auditors because they don't have that substantiation on a regular basis. And a lot of organisations then leave this to the end of the year to do. They'll just do their use one method during each month, but then wait for the end of the year to do all the major adjustments, which then is a drag on everyone's time. So how do we solve this in terms of end of month close? It's making sure that you've got an appropriate system that tracks all this and has the one source of truth, but also a finance system that potentially allows you to track, your invoicing milestones, your acquittal dates, the revenue recognition rules, be able to actually automate your journals when it comes to end of month close. So therefore, you're not doing this manually and you're not waiting for human intervention. You're setting it up properly to begin with, one source of truth, and then it triggers the automation around revenue recognition. And finally, keeps a full audit trail. So therefore, it keeps the auditors happy as part of that process. So something you can do as a finance team and your finance systems to be able to automate this process. The other area that I see is quite significant drag on finance teams is the allocation of overhead costs. And this is really important, especially when you're dealing with grants. And the reason for this is that when you have a funding contract or a grant, you then have to apportion those costs, those overhead costs across all the grants. And that's because if you don't, you then how do you cover your overhead costs? And therefore, what a finance team is to do as part of the end of month close is spend a lot of time calculating these overheads. And the key, as I said, the key purpose of this is to find out first what is the true cost associated with that grant. Once you know true cost, you can actually start making better decisions. For example, when you apply for a new funding contract, you then can ask the funder, what is the appropriate overhead costs you need to charge? And they need to pay you. And if you look at then what are the common types of overhead costs, it could be overhead administration, it could be IT costs, software costs, rent of facilities, marketing and fundraising costs, infrastructure costs, and one of the really big ones is staffing costs. How do we allocate staffing costs and employee-on costs across? Now, what I see is three main different methods of overhead cost allocation. The first one I see is where the allocation is potentially done based on a factor that where it could be FTE or headcount, and we're actually allocating that cost based on the number of full-time equivalent employees. Okay, this is quite common when it comes to software, where they'll actually say, "Here's our software costs for the month based on headcount. We then want to allocate that across." Okay, that's one method I see. Another one I see is a percentage of revenue, where they'll actually say, 15% of revenue for that grant or for that funding, we then distribute costs across. So that's another example. And then another example could be where it's based on, for example, rent. Square meterage used could be example. So and if you think about it, if you're doing these revenue recognitions the allocations based on these items, you have to wait until the end of the month. You then need to understand what is the headcount, what is the revenue, what is the square meterage. And once you've got that information, you then need to do the calculations of overhead costs. And that can actually involve a number of days before you can have that information and slow down that process. So if you're doing this type of calculation, that's slowing you down, having a system that you capture automatically head counts or revenue or the square meterage, for example, statistical information, that then automates that calculation, then streamlines that end-of-month close process. So it's something that, if you're doing this, then how do you actually embed this into your finance systems, then to automate that process? So something just to be, cognizant of as part of the end-of-month close process. Why is our end-of-month close process complex? And why is it challenging when it comes to a not-for-profit organisation reporting? And one of the key fundamentals is that as a not-for-profit or education organisation, we have got so many different key stakeholders. And fundamentally, those key stakeholders want different information. And so if you think about a not-for-profit or an education organisation, we've got boards, we've got audit and finance committees, and they want information in a certain way. Then you've got the CEO and the executive team. They want information potentially in a different way. You've got the auditors. They want a full a set of financial statements that fully comply with the accounting standards and have got full audit trails. If you then think about your program managers, your project managers, your grant managers, they want information in a different way. Regulators, the ACNC or ORIC or ASIC, want potentially information in a different way. Then the funders, the funders want acquittal reports. They want information in a certain way. If you then talk about charitable trust or donors, a lot of times they don't want so much financial information, but they want outcomes. What have you achieved? How many meals have you served? How many people have you helped? So statistical information. So as a finance team, we need to prepare our financial information and reporting information to satisfy all these stakeholders. So when it comes to the end-of-month close, you potentially have to then have the information in the finance system that satisfy these key stakeholders. And if you then take an example, if you look at management accounts versus general purpose financial reports, if you're doing reporting information to managers, they want to see in a certain way. But also, if you're preparing things to comply with the accounting standards, that needs to also reflect in a different way. And so therefore, as a finance team, how do you navigate having a set of accounts that actually achieves both? And that involves a lot of teams spending time in preparing the accounts in a certain way, but then using Excel to manipulate that as part of the end-of-month close process, which drags on days in terms of preparing that. So let's use the example of, and this is a real life example, and I used to hate this. I used to hate strategic planning retreats by the board. And that's because the consultant would come in and take the board away and then come up with a 2-day planning session on refocusing the board on how, there's different strategic pillars. And so as a finance team, we've been reporting in a certain way for a number of years. And then all of a sudden, the CEO comes back to the retreat and says, by the way, in your next report, can you report on these 3 pillars? Let's say we want you to now report on social enterprise, disability employment, and NDIS. Now, this is fundamentally changing how we've reported on for the last 3 years. And one of the fundamental problem is that the finance systems typically, if you think about our current, on the left-hand side is how we're reporting, because we need to report this internally and we need to report it to funders. And so let's say we're reporting on a program basis. Now, we can't change that because we still need to do that. But let's say the board now says, can you please report on disability employment, NDIS, and social enterprise? Our current structure does not map to that. And so a lot of organizations, a lot of finance teams, then all of a sudden, as part of the end-of-month close, have to manipulate all that information into Excel to be able to then report to their board. So having a finance system or finance systems that enable you to map within the system to new reporting frameworks. So let's say we've got our disability employment services program and our jobs program, we're going to now map them to a category called disability employment. We can then have a map NDIS to an NDIS container, and then our social enterprises container. If our systems can do that with flexibility, what it means is that we don't have that dreaded moment of all of a sudden we are going to now extend our end of month close by 2 days because we don't actually have the information to be able to report on that. So this is, again, having a future-proof system that allows you to have flexibility to be able to report to different stakeholders when they need it in different ways, because this will happen all the time. The other key areas of reporting different stakeholders that impact are things like if you have an auspice. Some NFPs will auspice larger ones on behalf of smaller ones. So how do we cater for that? And because that could actually increase end of month close process. So all of a sudden you've got another small organization you're reporting on that can't form part of your normal board kit, but still needs to be reported on as a separate. Consortium. This creates complexities. How do we actually report on a consortium? All of a sudden, let's say we've entered in a consortium, how do we report on that? And then the other one is, I've seen really common that expands on end of month close. All of a sudden, you've got a new foundation or new entity. Inter-entity transactions and eliminations can increase close rates by days. So having systems that allow you to handle that and automate that is critically important. The other big area that I see that drags out end of month close is the reliance of other systems. So if you think about a lot of our transactions come from other systems. They'll come from a CRM. Let's say, I see a lot of our customers are using Salesforce for donations. And so that information is captured every day through Salesforce. And then the finance team needs to get that data into the finance system, and then reconcile it, and then it doesn't reconcile. And then that then drags the end of month close period out because we're waiting to reconcile those systems. So how do we bring those two together? How do we automate that? How do we integrate through automation tools to be able to have that data flow seamlessly and reconcile seamlessly? A lot of you will have NDIS, and there are so many systems out there that manage NDIS. How do we get that data flows from your NDIS systems into your finance systems? Payment gateways is another major pain point around visibility and bringing that data in. Your payroll systems, you've got different payroll systems. How do we get data in, and how do we make sure that we are tracking by employee into our finance system? Government portals, how do we make sure that we're getting that data in there? And there's lots of other systems, expense management systems. How do we then have that data in? So really important to understand those other systems, but then also have the tools that allow us to bring that data into our finance system to then streamline that end of month close process. Okay, so that's critical. And one of the key areas I see is that whenever we support our finance teams to eliminate and reduce end of month closes, we work really closely with the IT department, and this is we've got a really strong relationship with Roden. Roden is actually one of the IT partners for one of our customers. I've actually been for a number of our customers in the past, and we work really closely in terms of with Roden around. We've got the finance systems that we need to improve, all right, but Roden's helping us and the finance teams to actually automate the integration with some of these systems into our finance systems. So Brad, I'm going to hand over to you now, and for you to share your learnings in this space and how you can support NFPs. So
awesome.
I'm going to stop my sharing.
Great. Awesome. Thanks for those insights, Nunzio. It's really, really important to not just think about the process itself and the fundamentals of how to get from the actual end of month to the end of month close, but the systems that surround it and how organizations can sort of go through this process of streamlining and understanding the way that they can sort of make sure that they're spending the most valuable time in the right places. So I'm going to take a bit of a step back here and just talk about some of the themes that Nunzio's already touched on, but just have a look at the way that digital transformation and technology plays a role in the not-for-profit space in general. So to give you guys a bit of background about what my sort of day-to-day focus is I work with several Rodan customers in terms of helping them with their strategy, helping them with their technology function as a whole, and working with their leadership teams to work through the challenges that they're facing and come up with a really kind of clear operating model for using technology in the most effective way. So one of the problems that I face particularly when talking with not-for-profit organizations, but generally with businesses as well, is that they tend to feel the technology problems before they know what they are. So they're often hiding beneath the surface, and they'll be experienced in ways of things like slow systems or security near misses or deadlines being difficult to achieve. So like what Nunzio is talking about with the end of month close and the kind of the chaos and the pressure that gets created around getting all that done in the right time frame. And essentially it ends up in frustrated stuff. Things just don't seem to line up together. But what usually causes them sits below the surface. It's the things you can't see. And often it's not actually the technology itself. It's things like unclear ownership. It's potentially hidden risk, or poor decisions where you've selected technology based on what it does on the sticker, not what it needs to do for your organization, and haven't gone through the right level of scrutiny to understand how that system does the thing it says it does, and does it line up with the way that you need to do that process. And it also often leads to accumulated technical debt. So this is the cost of having a system that's not optimized or streamlined for how you operate as an organization. And so when the technology leadership function is working really well, these things aren't really visible, but the issues happen. And when it's working well, the issues don't happen as much, that the outcomes quietly improve. And so I want to start to unpack, what does technology leadership look like and how does that kind of work in a bit more detail. But one thing that I do is, and what Rodan is able to do, is really get to the bottom of what's underneath the surface so that you can create that stability, that confidence, and build momentum around what you're doing. Now, having a look at the way that a IT function works, in terms of looking at the way that the IT functions within organizations, you've got your kind of operational layer, your functional layer, which is how do you structure your capabilities and controls across the organization, and you've got your strategic layer where you set the high level direction, the intent, and sort of the accountability for technology risk across the organization. Most NFPs and most businesses as well get stuck down in this operational layer. What are we doing today? What are we doing in the next foreseeable future? And how are we going to get that done? And so what that ends up causing is, this feeling like you can never really make the long-term improvement that you want to make because you're just coping with where you're at today. And so what I want to do is give you some ideas about how you can get your head above water. To just frame the conversation for today, I wanted to use this slide from Pitcher Partners. They did a not-for-profit survey in 2025, and there's some key and very interesting stats on this that came out of part of this survey that I just want to kind of gloss over really quickly, just to orient the next part of the conversation. So the first one is that 56% of NFPs are reporting challenges relating to operating costs, and that's 24% more than 3 years ago. So things that can help from a technology perspective in this space is things like data integrations, automations, things like generative AI. They can all allow staff to keep focused on the really impactful work and be a force multiplier in making sure that the organization can achieve more with the same level of staffing and the same kind of operating costs. Now, this is the stuff that Nunzio was alluding to before in terms of what he's and his team have been creating with the customers that they work with. They've been able to create quite a good, not just a a finance system and a way of administering the processes that they need to do in the financial and accounting services they provide. But they've created a stack that is able to really be adaptable and flexible to each individual customer's needs. And they're very proactive in understanding the real world impact and the mechanics of how an organization operates and what they're going to need from a financial reporting and administration perspective, and being able to reduce the amount of time that's being spent on tasks that are not valuable. So, this is something that really does make a big difference for organizations. And it's something that can be used across the board in every area, not just the finance area. The next thing I wanted to call out was that 37% of NFPs are reporting challenges in increased regulation and compliance. There's a number of reasons for that. The ACNC has increased the level of reporting that they require, and obviously with that level of governance and oversight that needs to take place in the not-for-profit sector, that means you've got a board that you're accountable to. They'll have their own ideas about what needs to be kept an eye on and reported on. There's increased regulation around things like NDIS and other other areas as well, where you might be getting your funding from and delivering services in. And as well, like there's been, like, for example, the Cybersecurity Act and the Privacy Act strengthening that happened a few years ago. That's increased the level of oversight and responsibility that directors have in terms of oversight over the organization. So the reporting compliance is something that's always increasing. And so one key strategy here is not just about thinking about how do we report on this thing at the point in time where we've got to generate the reporting, like so the board reports or the compliance reports or whatever it is at the end of the process. As Nunzio rightly pointed out, it's about capturing these key metrics along the way and having it as part of the process. So when you follow the procedure, the natural outcome is the right information is gathered and available in the right format, so that the reporting is simple at the end of the process. So you don't want to be going back and recollating and retrospectively figuring out what happened. You want almost like an organizational telemetry sort of approach to this, is to capture things as they happen and make sure that activity is really streamlined and easy. The next thing to have a look into is the fact that 71% of NFPs are diversifying their funding models. That's a lot of organizations trying a lot of things. And one of the big problems with, or the big challenges in that space is there's a lot of risk in trying something new. Not just in terms of, the risk that things won't work, or the risk that you might put a decent amount of investment into trying something new and not being able to recover that investment. But in terms of staff time, in terms of complexity, you don't necessarily know the future impact of trying something. When you're looking at potentially bringing on a different sort of channel of donations or applying for different grants, you don't fully know the picture of what that's going to cost long term up front. And so there's a lot of balancing risk and being able to make really strong and effective decisions quickly there. So making sure you've got an open ecosystem that can support, powerful data integrations, automations, and things like that will limit the risk there and allow you to be more adaptable. The next thing is that 51% of NFPs are investing in technology in general. So that's great. But one thing I'm going to talk about in a minute is that the go-to approach for a lot of NFPs is really taking on these monolithic transformation projects, multi-year projects or long-term projects that are designed to deliver a tangible result, but they take a lot of time and a lot of investment and quite often don't hit the mark. They don't really get you where you think they're going to be, but there's a lot of money going into those types of projects with the intent to make improvement. But that model's kind of changed a little bit over the last few years. So I'll talk about that in a minute. But 24% of not-for-profits are drawing more heavily on capital reserves. So when you think about operating pressures, when you think about the increased regulation and compliance, diversifying funding models, and investing in technology, a decent amount, a material amount of not-for-profits are using their rainy day fund, their capital reserves to do that work. And so it's really, really important to make sure that if you are in that position where you're investing your reserves, you're spending the money that you've got sort of put away, you want to make sure that you're getting the return that you expect to get, that it is effective investment, and it is something that is going to move the needle for you. And just to kind of round out this slide, some of the big pressures in the technology space are cybersecurity. Leads into the regulation and compliance obligations that most organizations have. It's a huge area for investment. ESG as well is something that if you're not in a position where you've been thought about how you're going to track that and thought about how you're going to account for those types of programs, it does make it very difficult to retrofit, as Nunzio was sort of pointing out before. And the last one is generative AI. This is something that's really kind of gathered a lot of steam. There's a very high adoption in a not-for-profit space of generative AI, and it's something that's happening very, very quickly. So in terms of not-for-profits are having to adopt that very quickly, not necessarily in the way they would have planned to. And so these are all things that have, particularly the cybersecurity and the generative AI space, they're things that have not necessarily been planned when you think from a strategic planning perspective. They're programs that have come up reactively and being retrofitted to kind of tick the box and move forward and deal with a real problem, but not necessarily have the long-term or medium-term thinking about how that's going to impact the organization over time. And so generally what I'm seeing in these sorts of situations is that the challenge is not so much the technology itself. It's really the approach that organizations are taking as they go into projects to deal with, like to implement a new technology or to deal with a technology related problem. And I'm going to sort of unpack a little bit of why and what I'm seeing. So over the last sort of 10 years or so, we've seen a very big shift, just even looking at the cloud adoption as a starting point. In 2015, less than a quarter of Australian and New Zealand NFPs were using cloud platforms, and most expected they never would at that point. But today we're seeing 87% are on cloud collaboration, and that's a really huge shift. I know it's 10 years is a long time in the tech space, but going from, we're probably never going to do that to, close to everyone is in that space where they're using cloud in some way that they didn't foresee 10 years ago. That's a big change. If you look at specifically just generative AI, in the last 12 months, the AI across the NFP sector in terms of adoption and usage has doubled. 2/3 of NFPs are now using generative AI. And that's a very, like when you think about how you would normally sit down and plan your strategies, you might have a 3 to 5 year kind of high level strategy and a 12-month kind of, business plan or detailed plan. 12 months ago, you may not have known that you were going to adopt generative AI in the way that you are today. And that's something that's probably happened inside your planning cycle. And so when you need to be reactive or need to be able to adapt to technology and make the best use of technology, the rate of change that's happening within the technology space is increasing. So being able to do that forward planning is not necessarily in the way that you would have in the past is not necessarily working anymore. And so the other thing that's important here is that if you're moving at pace with these types of technology implementation projects, meaning adopting generative AI inside a 12-month period, what a lot of organizations will do that more from a best effort perspective. So they'll look at the opportunities there might be to use generative AI. They'll come up with a high level plan. They'll start to maybe go buy some Copilot licenses and do like a Copilot readiness assessment, for example, and then start using it. But they haven't really sat down and thought about how does this change the way that people work? How does that impact their job descriptions? How does that impact future workforce planning? How does it impact risk and at that high level? And what are they might think about cybersecurity, they might think about privacy, they might think about just getting people practically using it. But, it means they're probably working at speed. They're probably progressing through these projects without necessarily showing they're working, without documenting what their intentions are, what their plan is moving forward, and how they see AI as being a productive and useful thing in their organization. And ironically, what that means is when you go to use the AI tools that you've got to do strategic planning and things like that, it now doesn't have the context because you haven't written it down. because one of the key things that you need to be able to do to make the most out of a generative AI platform is have a reference point, have some sort of like instructions for it to follow. And if you're not showing you're working, you're not doing your planning, you're sort of working through things as quickly as you can, you're not sort of capturing that information in a way that you can reuse it. And so context is a really key thing for organizations to understand moving forward. And so looking at the sector, the top priorities have shifted quite dramatically. Going back to just standard sort of data and analytics. In 2023, data and reporting for evidence-based decisions was a top priority for 17% of organizations. That figure is now 44%, so nearly triple in 2 years. So what we're seeing is a huge shift in the rate at which organizations are having to adopt technology and use technology across the board to help with their, apply downward pressure on operational costs to be more effective at what they do and creating more impact. But on the flip side, the traditional playbook, the old playbook, is starting to show signs of failure. So most NFPs, when they recognize that they need to change, the default way they do that is to go through and scope a transformational project. They get their funding, they engage an external partner, and they plan to go live on some sort of new system or platform in 12 to 18 months. But what we're actually seeing is that often results in failure. McKinsey and Oxford studied over 5,000 large IT projects, and on average, they ran 45% over budget. They delivered 56% less value than they promised. And the part that matters for most decisions that we're making every year is every additional year that the project runs adds another 15% to the cost overrun. So the longer that a project goes, the more likely it is to fail. Bain found in 2024 that 88% of business transformations fail because they failed to achieve their original ambitions. They found that 88% of business transformation projects fail to meet their original ambitions. Standish Group's analysis of 50,000 projects shows that nearly 2/3 end in partial or total failure. So this isn't a fault of the technology. It's a fault in the way that the technology is being implemented and delivered, and the misalignment between expectations or needs and the actual result of the project. So this delivery model of undertaking these monolithic projects, these big transformational ideas, means that quite often what happens is you get the right picture when you start, but halfway through things start to change. And the longer that you spend getting to that endpoint where something is delivered and usable, the more that the original requirements deviate from what you need to do as an organization. And so adoption is outpacing capability as well. So not only are the requirements changing between the start of the project and the delivery of the project, but once the tools are delivered, the platform is implemented, people don't know how to use them as well, and they end up having to go through quite a big sort of process to understand and utilize the tools properly. So if you have a look here, in terms of technology adoption, cloud platforms is about 87%, generative AI is about 67%, and AI in some form of business function is at 78%. But only 14% of organizations actually have an AI policy that goes into any depth that explains how they're using AI. In terms of cyber security, only 23% of organizations have a cyber security plan, an incident response plan, and only 31% of organizations are saying that their data capability is strong. So there's a big difference between finishing the project and delivering the value. So often what happens is you've got this 12 to 18 month period where you're focusing on implementing the technology. It finally arrives, but you're seeing adoption rates really, really low, and it's not really building the capability that you need, the capacity that you need. And so the completion of your projects, your IT projects, is not necessarily translating into the organizational capacity that you think it can or think it should. And so one of the solution here is to rather than focus on big transformational projects, which by definition a project is something that has a beginning, an objective, and an end, you're talking what the better thing to do is focus on continuous improvement. So not something you do every few years, but something you do as part of the way that you operate. So the three C's to help with this are context. So understand how your organization creates value before you change it. Otherwise, you implement the same problems in a shinier platform. The second C is cadence. So small, frequent improvements that compound. They're far more reliable than 18-month transformations, and you get value along the way. So you get a very short period of time between when you start the initiative and when you have something tangible that delivers value. And the good thing is that if you're finding that you're not delivering value, you can change the idea very quickly rather than have to wait for 18 months before you find out that it didn't work or didn't work the way that you expected it to. And the last one is capability. So build the in-house ability to spot what needs to change and then drive it. Technology enables this, but it doesn't replace it. So I'm not talking about necessarily capability in your IT function or your IT leadership. It's again, one thing that's changed over the last 10 years in particular, and definitely in the last 5, is that IT has really become a whole of organization problem. It's not a specific siloed technical expertise that's with those guys over there. It's part of everything that happens every day in the organization. It's such an enabling or disabling part of how organizations run that it really needs to be a shared responsibility. Yes, there needs to be an expertise in the technical implementation side and understanding the nuance of what how to make the technology platforms that you've got work well for the organization at that technical level, but the practical aspect of how the processes are supported by technology is something that everyone needs to understand. It's a shared problem, a shared responsibility. And so what organizations need to transition into is not seeing it as we'll get a vendor in to solve that, or we'll get our IT, like our CIO or our IT manager to deal with that problem. It's something that everyone needs to own and be part of the solution. So just got a few examples of how you might have approached this type of problem 5 years ago or 10 years ago, and a different approach you could take today. So when you're thinking about data reporting and analytics, rather than spending 12 to 18 months building out a data warehouse and a couple $100,000 to try and create this well-engineered, perfect data ecosystem, you can quite easily start with a tool like Power BI, or there's a number of tools that you might already have within your organization to start building out dashboards or reports that will solve, say, the 3 most painful or impactful areas to enable decisions. So look at the decisions that you're struggling to make, the reasons why you're struggling to make them, and then what data do you have that can help solve that or make that problem clearer, or to surface the issues that you're having, and help you know when you need to deal with something sooner. And comparatively, you're talking about a much lower investment, and it's something that you'll have a workable product or workable solution pretty early on, and you can then iterate from that and start to build it. Now, the important thing about that approach is not that it saves money or it's quicker, but you're building organizational context along the way. You're building that capability that you need to solve these types of problems collaboratively and well. Every time you go through an iteration of something, you're having conversations about how things need to work. You're looking at your processes and seeing why they don't work or why they do work, currently, and you're getting a better shared understanding of what the value is of what you do as an organization. Another area is automation. So ideally automating work that doesn't need a human. So a lot of people a lot of organizations will say, let's replace our finance system, let's replace our CRM, and spend 9 to 12 months implementing that, but essentially end up with the same manual processes in the new platform, and it doesn't really move the needle. It's not going to change the way that you, unless you put the time in to really get to the nuts and bolts of what you need and anticipate your future requirements and get into that depth, you're not necessarily going to solve those problems. And so a better approach is to start looking at the most 20 repetitive tasks that you've got across the organization. Automate 1 or 2 per quarter. Use something that you've already got. It could be something like Power Automate or Copilot, which you might have within your Microsoft environment. I know Salesforce has similar tools built into it. And there's a lot of other tools that would be available depending on what platforms you're already using. But focus on understanding the problems, understanding the processes. First, make sure the process isn't the problem, because it often is. I know that there's been quite a few situations where, like, one example was we were doing a CRM implementation project, and we sat down with the supporter relations team and I asked, okay, how do you do this particular process? And they explained it. I'm like, well, it seems like you're kind of going around like this to go in a straight line. Why are you doing this deviation here? And they kind of said, well, it's how we've always done it. And I kept asking questions from different members of the team and some of the people from other teams, and found out that 3 CRM systems ago they had a limitation about how much data could be processed at once. And this dogleg they were doing to work around it was where the problem was in that CRM platform 3 generations ago. So they didn't need to be doing any of that work, but they were, and it was taking something like a week every month for them to do this dogleg to get things finalized in time for reporting requirements and all that kind of stuff. But that often happens, is that people don't stop and ask, why are we doing this process? And get to the bottom of it. So going through that is really, really important, and looking at how you can automate and take things off people's plates so that you can get them to focus on the work that's most valuable for them to be doing. And the last one, just quickly, is building security as a habit, not a project. With the increased scrutiny over data breaches in particular, a lot of organizations have realized they were lagging behind in this space, and they've gone through projects to implement where a bunch of different things. Basically, the go-to thing seems to be for a lot of organizations is, let's get ISO 27001 compliant, when they don't necessarily need to be. But what that often results in is you spend a good period of time, like it could be 12 to 18 months, it could be 9 to 12 months, getting this certification, or getting to a point where you can tick the box on this certification, but you have a binder full of no one really understands or has read. They meet the requirement, but no one knows what to do. No one knows how to actually comply with those policies. And then now there's a whole bunch of compliance work that needs to be done. And that's now someone's responsibility to pick up that workload. So you've added more work to your plate, not necessarily made anything more secure, because people don't understand what the policies are and they're just doing what they did before this all happened. And it's now sort of less effective. Whereas taking the approach of starting with something simple and getting all the basics right, essentially it's a good starting point for that. And focusing on 1 or 2 controls per quarter, and focusing on 1 or 2 controls per quarter, and then working through that is much more sustainable. And you end up with actual change. People will change their habits because they're part of the journey. And that's a really important part of the security process. So that's a much more effective approach. And yeah, cool, you might need to be ISO 27001 compliant, but if you go through that approach of building it slowly and increasing your capability as you go, then what happens at the end of it is the compliance effort that you need to put in to maintain that certification is much lower, because you've got that built into the way that you do things. Everyone understands their role. It distributes the load evenly across multiple functions and team members and all that kind of stuff, and just makes it much more sort of achievable. So what we're trying to do here, or the main point I'm trying to get, is rather than planning these big initiatives in silos and delivering these capabilities over time, the better thing to do is start to still have your ideas, still have these high-level initiatives that you want to deliver, but break them down into the smallest chunk possible, and think about, as an organization, what's the best order to tackle these things in? How do we make sure that we're delivering value constantly? How do we make sure that we're building on the work that we've already done and breaking it down so that it's manageable, it's effective, you can see where you're going off track, you can make decisions to deviate one way or the other based on getting a better result or avoiding a negative result, and it'll be much more effective over time. And so, for a lot of organizations, getting the expert guidance on building that capacities, how do you actually go through the process of breaking those things down? How do you think about this? What are the kind of key skills that you need as an organization that you may not already have? Having that expertise on hand is really a key factor in addressing some of these challenges. And so just quickly, I'm going to go through the process that I go through when I sort of get involved with a new organization. And so you can start to think about what the approach might be for you. So typically I start off with just discovery and alignment, making sure I understand how the organization is operating today and where there might be any pain points or you know, misalignments in terms of strategy and things like that. Then from there, we start to look at where the gaps are and build a bit of a strategy about how to move forward. And we take that strategy, develop it into a roadmap, and then focus on delivering that roadmap through the lens of continuous improvement. How do I make sure that when things are sort of said and done, that you've actually got something tangible and useful delivered and can continue to build on that? And one thing that's important to remember too is that, like, when you think about IT, most people think about the core systems and tech landscape only, but there's much broader set of things to think about. There's your finance and vendor management, there's your cybersecurity, delivery, support, and continuous improvement is obviously something that I've been talking about today. Business alignment and strategy is really important, and also people roles in the operating model, like who does what, who's responsible, how do we get things done? That's also really important. And so just to wrap things up here, there's a couple of ways that Rodan can help you if you're sort of finding some of these challenges are real for you. The first thing is we have, like, Rodan provides a managed service for IT support and maintenance of your infrastructure, your Microsoft environment, all those types of things. Our flagship offering is Secure Managed Service, which basically provides Essential 8 Maturity Level 2 alignment out of the box. So that's something that we are able to sort of own that end-to-end delivery of that, and provide not just your break fix support and your maintenance of your infrastructure, but take on that whole security aspect as well. Second thing, and this is the space that I work in, is we have our CIO and CISO, or Chief Information Security Officer, as a service, where we provide a C-level executive leader who can work with your organization to uplift your technology function. And that's a flat monthly fee that we provide that for, as an ongoing sort of service to help augment your existing leadership team and provide you with the right advice and capabilities that you need. And the last thing, if you've got some gaps that you can see, maybe doing a tabletop exercise or a maturity assessment might be helpful for you. So we can do like a cybersecurity incident response tabletop exercise where we walk through with your team. How would you respond to a real world incident as if it was happening? We sort of do a bit of a wargaming tabletop exercise around that. And we've got several maturity assessments we can do on AI, technology function, cybersecurity, and IT infrastructure as well. So there's lots of different ways. But I think the important thing here is to think about the way that you're approaching technology in your organization, looking at understanding the real problems, breaking it down, trying something that's got some tangible benefit, that's not going to sort of, you're not trying to solve all the problems at once. Moving things forward in small incremental steps is really, really important. And understanding the way that technology can enable what you're doing and make things easier is really, really key as well. So it's going to hand back over to Lee to wrap things up.
Yeah, amazing. Thank you, Brad. Look, yep, we're a little bit over time. So if there are any questions, please feel free to put them in the Q&A. We have contact details there, and we'll come back to you offline. Before we wrap up, though, I just wanted to give an opportunity, Nunzio, that if there is anyone here today that are dealing with some of the issues that you've walked us through, whether it's around revenue recognition, challenging with their cost allocations or end of month, what's the best next step here for them to engage with you and the team at Junta?
Yeah, thanks, Lee. Just to send an email that's on the screen, info@juntabel.com.au. And one of the things we're offering today is, because I don't want anyone to experience the pain I experienced. So we provide, one of the services is around a diagnostic where we do a total review of your end of month close. We exclusively to the members that have joined the webinar today, the first two that send an email to that and put in the word diagnostic, we're going to offer a pro bono service. Look, it's valued at $15,000, but we're going to offer the first two that send an email through. We'll be doing that fully pro bono and give you a full diagnostic in terms of supporting you to eliminate your end of month close.
Fantastic. Thanks, Nunzio. It's certainly worth sticking around. So thanks everybody who attended today. Really hope you got some value out of that. We said if there's obviously any questions or any follow-up, then please feel free to reach out to the team at Roden or the team at Junta. Thank you, everyone.
Thank you.
Thanks, everyone.